Ladies and gentlemen, what would you rather hear about than a remainder, a line labeled other, on the People's Bank of China's balance sheet? Isn't that exciting? Isn't that interesting? I swear to you, it will be very interesting. We're going to talk about some complex topics, but at the end of the day, there's going to be a very simple measure. Jeff Snider found a remarkably simple one-line measure that says, if this is going up, beware, be concerned. Now, the explanation of why that is may get complicated, but it's very educational. I thought this was one of the more innovative, unique, original pieces that Jeff has written in this year, at least, let's say. Jeff, enough about you. You work for For Alhambra Partners. You're the head of global research, and you wrote this on the 27th of October. It's called China's Central Bank Condition has consistently told you everything about global, not inflation. I think the first, yes,
I don't know if it's going to be interesting, but it's definitely important. And really, as we say a lot around here at Eurodollar University, if you want to know something about the global monetary system, you want to know something concrete, one of the best places to look, maybe you don't believe it or not, one of the best places to look is the People's Bank of China's balance sheet. And maybe if you don't really know a lot about the monetary system or the way the global economy works, that sounds ridiculous. But once you start to put some of these pieces together and understand how it works inside that framework, it makes perfect sense. Because the Chinese are one of the biggest players in terms of global trade and moving stuff and goods around, which means they have a very huge need for these US dollars that are created outside the United States in this Eurodollar system. Therefore, China Eurodollars used to be a match made in Communist Party heaven, but ever since around, August 2007, it's been more of a troubled marriage than anything.
And we've seen this in other countries in other periods, leading up to the Great Asian Financial Crisis. I added the Asian Financial Crisis, 97, 98. We saw the same thing. We saw rising foreign exchange reserves at the Asian tigers and the ASEAN nations. And then when the global regional dollar shortage occurred, things went into reverse. So if rising foreign exchange is a good thing and falling is a bad thing, what about dead, straight, unchanging for months? What does that signify?
Signifies manipulation, right? I mean, we live in a dynamic world. It's like, you don't expect straight lines to appear in nature because they don't appear in nature. And so you don't expect straight lines to appear in a dynamic system because what appears on the outside to be random like nature, if you see a straight line, it can only be by human intervention. So if we see something like that, immediately your curiosity should be raised and your inquisitiveness and skepticism, because what you're seeing is, okay, if something is being manipulated, why? Really, what's the purpose of manipulating something if everything's really going along as to plan?
Now, the good news is, Jeff, as we look at this PBOC balance sheet as reported by the PBOC and by SAFE, we see that there's a rise recently in the assets. So this is great. Foreign assets are going up. So this is a good news piece of news. At least we would think so. But you dove in deeper.
Yeah, right. It's the flood of money finally showing up in China. I mean, we've been talking about this for years now. The PBOC's foreign assets holdings on its balance sheet have been ridiculously straight and narrow, and therefore no volatility whatsoever, which has already got our skepticism raised. And then all of a sudden in 2021, after hearing Jay Powell talk about his flood of digital dollar, about hearing about too much money in the reverse repo and everything else this year, is it finally starting to reach the People's Bank of China's balance sheet, which is where it would reach if it were actually happening? So are we finally seeing all of these things being put together? And the answer is, well, it requires a little bit more work, because the level of foreign assets, even though that's the dominant portion of their balance, the asset side of the People's Bank of China balance sheet, it actually isn't just all foreign assets. There's actually three broad categories. By far the most is something called foreign exchange, which is these assets that we're talking about. But there's also a couple other assets that are included, including monetary gold, which we're going to ignore, sadly, because the world ignores gold, not my rules. And then there's something else called other. And if you do this long enough and you get into a lot of these details long enough, what you'll see is there's always an other. There's always a miscellaneous somewhere. And usually this other and miscellaneous tends to be far more important than the name would otherwise suggest. Other makes it seem like it's just some stuff all the way at the end of the line. Who cares? It's back burner crap. When in fact, maybe this other is where everything important is.
Let me just make a very quick comment about the official gold holdings. China, the PBOC, didn't report that there were any changes to their official gold holdings gradually, right? There wasn't any gradual increase. They just said all of a sudden, oh, by the way, we took on 1,000 tons of gold this month, this quarter. They did that a couple of times, Jeff. You will not be surprised to learn that this occurred during Eurodollar crises. Coincidence? Absolutely not.
Yes, there are no coincidences when it comes to inflation, money, China, Eurodollars, or any of these things.
See, I mean, they were accumulating the gold the whole time. It's just when they chose to report it. That's the point. When? For narrative purposes.
Almost like they're trying to portray confidence, right?
Yes, exactly. Yeah, there's 1,000 tons here. Did you know that?
Yeah, hey, things are going bad, but look, we got a bunch of gold that we didn't tell you about. Yeah, amazing, right? It's a complete mystery.
If you don't follow this show, you would think, well, that's just 2 random months. I wonder why they reported it. Those months stand out on the Eurodollar radar screen. It's like, oh, yeah, well, I'm not surprised. This is when they announced it. Okay.
And that's really what we're going to talk about here with other foreign assets. It's the same thing. The correlations are so ridiculously on the nose. It almost seems like we have to it almost would seem like we're making up these numbers to fit our narrative, when in fact they fit our narrative so easily and so well. It's because the People's Bank of China goes through these dollar periods and decides we got to do something about it. And we're really kind of limited in the ways that we can act. So we'll do this.
Let's go back 14 years. We're looking at this chart right now from 2005 to 2009, where we see foreign assets, other, barely, we don't see it really, and foreign assets, foreign exchange. Now, until a certain
random month, right?
Those are lockstep.
August 2007. Let's just pick that one out of thin air. August 2000. I've heard that one somewhere before.
Incredible.
So we have total foreign assets, which is again by far the majority. Back then, it was almost the entirety of the asset side of the People's Bank of China balance sheet. It's where all the money comes from. And this is China's participation in the global economy, where lots of dollars pre-crisis were flowing into China, many of which ended up on the PBOC's direct hand, or the Communist Party, the government's direct hands, which were placed in the central bank's coffers. Not all of that, though. There are other assets. We just said there's 3 different parts of foreign assets, one of which is foreign exchange, which are these organic Eurodollars showing up in various Chinese hands, ending up on the government's balance sheet. And then there's this other that started rising. I mean, it was always there as sort of a remainder, but it started rising specifically in August of 2007. Now, not all Eurodollars and foreign exchange ends up in the government's hands. Some of it, a lot of it, we don't know how much of it, ends up in their policy bank hands. They're not really private banks. They're state-owned large banks, China Development Corporation and the Import-Export Bank. Some of the other ones, the big 4 there, they own their own sources of foreign exchange as well, as you would expect, because they're out there doing this foreign exchange trading business too. And in August of 2007, just out of the blue, randomly, the People's Bank of China said, as part of your reserve requirements domestically, we're going to start this month, for reasons just random reasons, we're going to require that you start depositing at the PBOC some of your dollar holding. And we're going to report that under other foreign assets in terms of what the PBOC holds, when these are dollar deposits of their local big banks as part of the reserve requirement. Why August of 2007? Most people to this day can't tell you. Even these China watchers and experts don't seem to connect the dots here. But when you realize the significance of Eurodollar dollar shortage, why would China start making its own constituent banks start holding these dollar deposits with the central bank, specifically in August of 2007?
Now, you also have a couple of dashed lines here that depict the rate of change. And so we see in August 2007 that we have they separate these 2 lines from each other, right? The just foreign exchange all of a sudden takes a severe drop, but maybe it's going to make a comeback. Maybe this was a one-off. Let's not worry about it. I mean, we'll worry about it, but we're back onto the Eurodollar choo-choo train and we're powering forward all the way until March 2008. And then we see both of these lines take a completely different lower rate of growth. A break. It's the break is what I'm trying to say. We observed maybe a wobble. We're back to where we were. Ignore the wobble. Then no, there's a complete break with the past.
Right. It's sort of like our what we remember of the global financial crisis, right? There was a first phase and then there was a second phase. And the second phase was the terrible phase. And the first phase was pretty bad, but even then it seemed like, okay, this maybe isn't horrible, isn't earth-shattering. And you can see that's kind of what happened from the People's Bank of China's perspective. They said, well, foreign exchange is something's going on there. We're starting to see some disruptions in the global dollar markets. Maybe if we have our banks push some of their foreign reserve assets onto our balance sheet, that will kind of fill in the gap. And as we said before, maybe that will instill a bunch of confidence in the system. See, look, we still have the same foreign assets, even though the composition is a little bit different. So you can see it's sort of one of those, something's not going right, but maybe it's not awful. So we'll just plug in the hole with this deposit liability, this dollar deposit liability. We're going to force on our local banks. We're reported under other financial assets for ourselves. And maybe it'll all just go away. I mean, the Federal Reserve in December of 2007, there's TAF auctions, there's dollar swaps. Maybe that'll fix the crisis and we only need to do this temporarily.
They did sort of do it temporarily because then they pursued another path. Now that we're looking at this other chart, we see these other foreign assets stop their exponential surge right at the time when all of a sudden the Chinese exchange rate to the US dollar was pegged, frozen, dead solid. What does this mean, Jeff? Is it a coincidence?
We don't really know. I doubt it's a coincidence, but I mean, it's probable that the dollar problem got really bad in the summer of 2008, which is the time period you're talking about. This is when we start to see even China saying, hold up here, something really bad's going on, right? And so even the Chinese are starting to make changes in how they operated. It's the Chinese Yuan at an almost 45-degree angle, all of a sudden stops. And it goes sideways. It's clearly pegged from that point forward, which is the second half of the global financial crisis. And I got to believe that at that point, these Chinese banks that have been forced into these dollar deposit situations with the Chinese central bank were saying, we're having dollar problems here. We can't put more of our dollar deposits with you because we might need them for our own purposes. And so the People's Bank of China said, well, what can we do? Can we make them continue to put dollar deposits up with us that they can't use in foreign exchange markets? No. So everything changed in the summer of 2008, which was the Chinese way of letting the world know something else had changed for the worse, not for the better, as most central bankers had thought in summer of 2008, that the dollar system had gone for the worst long before we ever got to Lehman, long before we ever got to AIG. As collateral problems were erupting, the LIBOR spread was still going on. The People's Bank of China's balance sheet and its balance sheet actions had told you things were going in the wrong direction, not the right direction.
Jeff, let's talk about the next Eurodollar phase, the European sovereign debt crisis. We've got the same graphs. We've moved forward from 2009 to 2012. And again, we've got foreign assets total, foreign exchange, and then foreign assets the other. And then you provide us again the Chinese currency. When the Chinese currency is going up, great. When other foreign assets are going down, great. But foreign exchange... Okay,
that's
tell me.
That's the thing, though, right? At that time, foreign exchange, at least in 2010, seemed like, okay, global financial crisis is just a one-off problem. It seems to be going back to normal, at least for China. Maybe there's a new normal in the United States and Europe and the developed world. For China, it seems like maybe we're getting back into the normal swing of things until, of course, early 2011, when we start to see the things start to fall apart in exactly the same way as they had in 2008, collateral, repo, derivatives, those kinds of things. And so the Chinese are saying, what do we do about a drop off in foreign exchange? Now we're not seeing foreign exchange decline, but we're starting to see some conditions change. The rate of change goes down, and then eventually it stops altogether. Can we make up the gap with this other foreign assets? Can we go back to these Chinese banks and say, we need you to post more dollar deposits and shift those private foreign reserves that you have onto the public balance sheet to make it look like the dollars are still flowing? And the answer was no. And you have to wonder, is it because these Chinese banks, these big, large state-owned banks were saying, we're having our own dollar problems, dude. You got to do this yourself. PBOC, yes, you're our boss and we got to do what you say, but you got to give us some slack here. We can't post any more of our US dollar reserves because we might need them ourselves. And so what you see is in the 2011 crisis, as opposed to the first part of the global financial crisis, is that this other foreign asset, this dollar deposit, if that's what it really is, it's sort of like a last resort tactic. It's like we only do this if we have no other choice, because it's a hardship for these banks that clearly don't want to do this. And it's not just, oh, we don't want to do it because it's a pain in the butt. It's we don't want to do this because we've got our own dollar problems. So when we see other foreign assets start to rise, we have to wonder if that's because maybe the PBOC doesn't have another choice. There's really not, the conditions must warrant some kind of last resort type of intervention.
We see another peg, but it's occurring now in foreign exchange, whereas before we observed it in the currency. So for this time period, we see the currency rising, signaling everything's okay, but it's incongruent with the foreign exchange holdings, which are now frozen.
Which gets into the real complications that are going on here. So something changed in 2011 where the Chinese said, we're just going to target a level of foreign exchange on our balance sheet. And how are they doing that? And I think part of the answer is they're engaging in swap transactions and what we call contingent liabilities, almost certainly with these large state-owned banks that we've been talking about before. So they're not asking the state-owned banks to openly and publicly post reserves that would show up as other foreign assets. They're instead engaged in probably stealth transactions with these same banks to use their foreign assets as the PBOC's foreign assets without calling them, without classifying them as visible public deposits. And it gets into this complicated, tangled soup and mess and disorder of basically stealth interventions. But we can tell it's going on because foreign exchange, the level of foreign exchange just completely goes flat, and which is, again, straight flat lines, sideways lines are in nature are a perfect example or perfect indication of manipulation. Human beings doing something specific.
Now we move on to the third Eurodollar crisis, a regional dollar shortage that occurred right in China. And we're looking at the same graph, Jeff. We've got foreign assets, other foreign exchange, the rate of change. What can you tell us about this particular moment in time and what we can interpret from the balance sheet?
Well, from the Chinese perspective, from 2013 forward, it really got serious. If it was just sort of, mildly annoying to certain, partly troubling, 2008 up to 2012, 2013 forward, it was like, okay, now this is a real problem. And what they decided to do in the outbreak of the third global dollar shortage in the series was, well, let's just start plugging our foreign assets, the public foreign assets, this foreign exchange assets on the PBOC's balance sheet. We'll start using them to fill in this dollar gap because, well, we haven't really tried that, and maybe that'll work. But the other thing is that the dollar problem in 2014 and 15 must have been so enormous that they really didn't see any other way around it. And notice also, you can see in our charts that we're presenting, that PBOC did not again require dollar deposits from its local banks, from the big four state-owned banks. There's no increase in other foreign assets. In fact, the most prominent part of that series is August of 2015, which many people might remember for what happened with the Chinese currency exchange rate.
It dropped a couple of percent
in a single day
overnight. Yes.
It was an enormous disruption in the summer of 2015 when, again, everything was supposed to be going correctly. The world, inflation, best jobs market in decades, everything's fine. We're going into global recovery when the Chinese are saying, what the hell are you talking about? It's chaos out here in the real world. And that chaos finally really hit home in August of 2015 when you can see the People's Bank of China actually pushed those dollar deposits that were still on their books into the banking system. They took these other foreign assets and the level just dropped, coincident with CNY's drop, which tells you the dollar shortage had gotten so bad in early August of 2015 that these Chinese banks were saying, give me our dollars. We need our dollars back from you. We got to use them. And it wasn't enough because CNY absolutely cratered in, I think it was August 10th or August 11th of 2015. So again, these things are not coincidence. It's not just random. We're seeing all of these things line up perfectly, where other foreign assets on the PBOC's balance sheet are likely dollar deposits of their state-owned banks that state-owned banks don't want to leave on deposit with the central bank, especially during times of trouble. So if the PBOC is saying, I need these dollar deposits from you, I'm going to put them in my own other foreign assets, what does that have to say about the conditions going on at that period of time? They can't be very good.
Let us move to our fourth example, the fourth Eurodollar crisis, which started, let's call it January 2018, a slower burning dollar shortage that was global again. Eventually, it would break out in March 2020. But in this graph that we're looking at, we're not including 2020. It's just through 2019. And again, we've got foreign exchange, this other, and the Chinese currency. And I suppose that you're drawing our attention here to September 2018, where we start seeing a rise in other holdings again, other foreign assets.
It's sort of the first half, second half. The first half was still globally synchronized growth, 2017, all that. And even though we didn't see a rise in foreign exchange on the PBOC's balance sheet, at least it wasn't falling. At least things seemed stable, and there was a modest increase in that. And during that time,
and other was falling,
right? But the other foreign assets were declining, which maybe was the PBOC saying, "We'll let you guys have some. We'll let you big banks have some of your dollar reserves back." And then, of course, we get to the summer of 2018.
The currency was rising too,
where the dollar's up. We got inversion in the Eurodollar futures curve. We got all sorts of stuff going on in the summer of 2018. Jay Powell says everything's great inflation. Mario Draghi says the same thing. And all of a sudden, we start to see changes on the PBOC's balance sheet. And as I wrote in early October of 2018, the Chinese were warning you that things were going the wrong way. We saw RRR cuts and things like that. And then all of a sudden, now we get a rise in other foreign assets again, which is why? Why a rise in other foreign assets? Why would the PBOC be in such a position that it's imposing upon its own big banks to say, bring me your dollar deposit?
Right, exactly. Two-step crisis there. In the first half, things seemed to be going better. Other was falling. The currency was rising. Then the currency started to fall. And a little bit later, others started to rise, which brings us to present day, Jeff. Again, same pattern of graphs. We're looking at the same things, other foreign assets, foreign exchange, and the Chinese currency. And back to how we began the show, we were talking about it would be a good thing if we saw the People's Bank foreign assets rise, foreign exchange assets rise. But once we dive in deeper here, this very first graph, Jeff, it's not the good part that's rising, it's the other that's rising.
Exactly. It's what we're really saying is that if there was a dollar reflation, Eurodollar flood, even just a modest Eurodollar increase, we would see on the People's Bank of China balance sheet, foreign exchange part of foreign assets rise. And that's not what we're seeing at all this year. In fact, foreign exchange has been even more suspiciously straight line than ever before. And the only thing that has risen is other foreign assets. And not just that, again, there are no coincidences here. Other foreign assets on the PBOC's balance sheet have risen at the same time the Chinese yuan stopped rising. So going back to January, the yuan was going up against the US dollar, which was reflation, good things, dollar flows, that kind of a situation. Since January, again, this entire year, as we've talked about before in the TIC data, this entire year has been the opposite of inflation in terms of the monetary system. So just from China's perspective, you have CNY, which is no longer rising, and now you have other foreign assets showing up in the PBOC's balance sheet, which again, as we look back through the last 15 years, is a suggestion, a hint, an allegation that maybe not everything is really good in the Eurodollar system, that the Chinese are imposing upon their own banks. If that is indeed what's going on here, and we don't know this for sure because they don't tell us. We don't know what other foreign assets are because it's miscellaneous. But it seems reasonable to conclude that they're doing the same kind of thing, this last resort kind of a measure, saying we need more of these bank reserves on our balance sheet for some purpose. And that purpose happens to coincide with all of these dollar shortage indications that we get, including the Chinese own currency exchange rate.
And then it's also corroborated, you mentioned it a moment ago, by TIC, the Treasury International Capital Report, hints of the same thing at the exact same time that the currency froze, not as much as in previous years, but definitely got stuck in a very
It's no
narrow
longer
band.
rising, right?
We
I mean,
see-
it was
Yes.
going up at a 45-degree angle. Now it's sideways up and down, but it's mostly sideways, which is something changed in January. That's really the important point there. As we say,
And the Americans
exactly,
corroborate
it's
it.
corroborated. It's not a random coincidence. We see this in TIC data. We see this in treasury market behavior. We see this in all sorts of financial indications that say something changed around January and February, and we can see it in all of these various places. And when you put all these pieces together in the Eurodollar context, it makes a very compelling, if not overwhelming, comprehensively intuitive, internally consistent story. And it's not an inflation story.
The part I wanted to mention here was that when I keep saying TIC, what I'm referring to is that the Treasury International Capital Report shows what the holdings are by China and Belgium, and we combine them, assuming that that all belongs to China, that those holdings of US Treasuries stopped rising, started falling in January of 2021. That's what I was trying to say.
All together. It's not random coincidence here. We're seeing these things happen at the same time because there is a common unifying factor behind them. And when we're talking about the PBOC's balance sheet, is maybe as counterintuitive as it is, that means dollar. That means Eurodollar. So the People's Bank of China's balance sheet is a very good place to start trying to figure out and understand what must be going on in the Eurodollar. You certainly can't go to the Federal Reserve or Jay Powell because they're off there talking about the unemployment rate and God knows what, when the Chinese kind of have to deal in dollar reality because they don't have any other choice, like most of the rest of the world. They can't bury their head in the sands of econometrics, instead have to focus on real money in real world, which, again, I'll say it again, maybe the best indication we have of how the dollar is actually behaving, the real funding monetary markets behind them, is on the Communist Chinese Central Bank balance sheet.
Jeff, I had taken the previous week off. I needed to tan myself. So is there anything that you wanted to bring to the audience attention, because we've been off the air for a couple of weeks, that we didn't cover last week, or anything to look forward to? Any wrap-up final words on this episode?
It's just, I think our what we're trying to get at here, but just recently, not just recently, but over certainly the last, maybe most of this year, is that in the mainstream media, the theme is too much money, inflation, overheating, red hot, when in every single, as I titled that one article about TIC, it's been unambiguous. It's unusually unambiguous how the deflationary monetary signals are all in the opposite direction. Dollar shortage, deflationary potential, collateral problem. So on the one hand, you've got inflation, bond rates are going to go skyrocket because of the inflation outbreak. And on the other, you have, from the Chinese central bank on down, a very consistent, concise story of no disinflation, deflation, dollar shortage. It's the exact opposite of what everybody's been saying in the media.